Welcome everyone to the Finity Passive Investing Conclave. The passive trends in India are now significantly growing. And let me go directly to the core of the discussion today and start with Navneet on the first question of this. If you've seen, there is already a mega trend that is unveiling. In the last 2 years, if you go by data, in the last 2 years, the mutual fund industry has added around 2.5 crore folios. Out of that, almost 1 crore folios are coming in passive funds, have come in passive funds. Even if you look at the year of 2021, almost 40 to 45% of the folios that have added in this current year have gone to passives. So, so it's almost like saying 1 in 2 folios approximately are getting created in passive funds, even within India. However, this trend is not really, highlighted to investors. And how do you see this trend unfolding, Navneet? And is this really, that the passive explosion that is happening in new folios getting created, not in assets maybe, but in new folios that are getting created? How do you really see this for the industry going forward?
Thank you, Manoj. Pleasure to be on this panel. I don't know whether it's the explosion word is the appropriate word because these are like very, very early days. Of course, I mean, globally, we have seen over the last decade or two a significant increase in assets under management in the passive category. In fact, as we speak, over the last year till date, I'm told 1,300 new ETFs have been launched, implying 6 or 7 new ETFs every day. So there has been, I would say, an overdose of innovation on that front, and increasingly a larger and larger part of the money has been moving towards passive. In India, of course, the active fund managers have got a long track record of generating alpha. I don't see any reason over the next several years they won't be able to replicate that. Having said that, I mean, there is a lot of scope for passives to grow in India, where a large number of people are yet to meet the market. I'm sure there is scope for both active and passive to grow simultaneously. I agree with you. In last couple of quarters, there has been a huge increase in the number of new investors who've been coming into the passive. And I think fintechs have really played a big role. Of course, there are a lot of RIAs who have also been promoting the passive funds. And of course, a lot of other distributors who have also been, for a part of the investors' portfolio, have been allocating to the passives. There's been a lot of innovation done by the mutual fund industry. Some of the regulatory changes that have happened have also increased the attractiveness of of ETFs. But we have a long way to go, because if you look at the overall assets under management of roughly, I think, 4 lakh odd crores at the end of September in passives between index fund and ETFs, more than 95% is from institutional investors, and primarily a few institutional investors like EPFO. The retail money into the ETFs is less than 5%, and that includes both the index fund as well as the ETF. So we have a long, long way to go, but this is a heartening trend where we are seeing a lot of retail investors coming into, individual investors coming into the passive funds.
Yeah. Yes, I'll take it from Navneet and take it over to Chandresh, continuing the same discussion. So we have currently around 1.2 crore, folios in passive funds, whether index funds or ETFs. And the primary growth of folios has happened in ETFs. It is not in index funds that we have seen. And if you look at as the overall industry folios, we have currently industry has around 11 crore folios. And out of that, around 10 to 11% of the folios now are in passives. With just 2 years back was just 3% of the total folios were passive, passive folios. So it has been a significant shift from 3% to 11%. But Chandresh, if you were to see from your vantage point, and specifically as rightly Navneet said, that active funds in India have delivered. They have lived up to their promise of generating alpha over longer periods of time. However, there is a certain segment of investor who seems to be, preferring passive, and that is an audience that is growing. From your point of view, and especially from an AMC, which has created significant alpha for investors, how do you see this trend in the next 3 to 5 years in terms of, the share of passives, in terms of folios, AUM, and investors looking at that?
Thanks, Manoj. Happy to be here. So the point is, actives plus passives essentially will make an investor's portfolio. Hitherto, we had seen basically the actives because those were the kinds of products which the industry started off with the trade was comfortable talking about, the intermediaries were comfortable taking these products to their customers, and the track record of the alpha generation obviously made investors feel comfortable, and more importantly, the intermediaries also feel comfortable taking these products. And that's how the exposure to the market. So ultimately, these products provide exposure to equity markets for wealth creation, largely, though now we are also seeing some fixed income products also coming in. But essentially, it was about exposure to market. Once that exposure has come in, and now with more technologies, etc., making even smaller tickets being available, number of products being easily being able to be showcased on various platforms, etc., we are seeing many investors who want to probably do it a little bit themselves, or there's a B2C angle, or more importantly, there is some level of information and education available to people. These products are really seeing some major explosion is the word you use, but I would say some preference. Even today, if you look at the industry has been doing maybe a lakh of crores in terms of gross in the last quarter. The amounts here are still less. I mean, I won't say, but yes, there are a large number of retail investors getting used to it. As I said, an investor's portfolio needs both actives and passives. Some kind of a rebalancing in favor of passives will happen. And it's going to be a long-term phenomenon. It's not going to happen in 1 or 2 years. I mean, it will take good 4 or 5 years for that rebalancing to happen. Now, what class, what kind of products, what kind of strategies people will move for passives remains to be seen. And that's where the industry will have to work along with our intermediary partners, and more importantly, engage with customers to help them build the right portfolios, right mix of actives and right mix of passives. Number of other things are also important in terms of, while we all talk about passives, there's a certain level of active support which is required even to passives. So whether it is index design, I think that is a very important one. Rather than indiscriminately just spraying a lot of products, I think we as an industry have a major responsibility to ensure that we get only sustainable indices in that sense on which these products are really built upon, because we understand that there may not be too much of hand-holding on part of advisors, etc. If an index goes wrong, then there may be an issue. So that's at one level. And second, I think more importantly, over a period of time, we will see emergence of another class of products, which maybe we can call as wrappers or fund of funds, which will allow really investors to benefit from these products, because over a period of time, every portfolio will need supervision, rebalancing, correcting asset allocations, etc. So this whole ecosystem will take some time to develop. And once it's done, I think the growth will be further speeding up, is what I feel over the next 3 to 5 years.
Yeah. I'll take the specific point, Chandresh, you mentioned about active plus passive, and I'll lob it over to Swaroop to expand on that. There is certain, if you were to demographically profile the investors who are coming into passive funds, it seems to be that it's a new generation of investors. It's a different class of investors, and they are actually taking a decision of passive versus active, whereas the earlier generation of investors seem to be sticking with active funds. So it seems to be currently the decision making process being active versus passive rather than active plus passive. So is that a trend that you see, and can you give us some insights into what is the demographic profile of investors who are choosing passives at this point of time, and how do you see that trend shaping up?
Manoj, thank you so much for having me for this discussion. Very insightful. Like you rightly said, I think whenever we get into a discussion like this, it invariably becomes an active versus passive discussion, which is not exactly correct. See, there is the present market and there is the incremental market. The present market and the incremental market, in my opinion, will be completely diverse. And when we are discussing the passives, it is more from the incremental market than from the present market perspective. Make no mistake, the present market has actually gained a lot from the expertise of active fund management. And let's face it, has created wealth in the last 25 years. The reason I say 25 years is AMFI is, completing 25 years. But when you look at the future is when it gets a little interesting, because finally the demography of the country is playing out. The younger it gets, the more interesting it will be. And please make no mistake that the young of India are economically far superior than what the present market or the existing investors is. So their decision-making ability or their decision-making process will be dramatically different from what used to be during, say, my phase or my father's phase. And purely from the approach to life perspective. I mean, there is a dramatic difference between the way I will look at life versus my son and the way he or your kid will look at your life. And that's what is playing out. Add to the overall fact that, everything is now digitally focused. And then that's where the change comes in. If you look at the last 2 years, there has been a huge shift, or you can say the comeback of broking in a certain way. And there, I think you can use the word explosion of demat accounts in the right format. I do believe that the demat accounts that have opened have not necessarily been opened just for buying stocks. And we are seeing it unfolding in the form of the little phase of ETF business that we've seen for ourselves in the last 1 year in particular. One of our funds we got launched, and very niche product called the FANG Plus, in 4 months' time got 1.2 lakh folios. And that, according to us, is a fairly large inflow from the present form of passive investing perspective. I mean, when you look at the overall AUM, and I think both Navneet and Chandresh were reflecting on it, let's face it, in 25 years, 88% of the equity AUM belongs to individual investors. On the overall mutual fund perspective, finally, 51% of the overall AUM is with individual investors. You contrast that to the passive investing, and Navneet rightfully said that, almost 90% belongs to the institution. This is like the active business 25 years ago. So there has to be an inflection point at some point of time, and make no mistake, this inflection point will be far quicker than what the active saw. Is a reality. I mean, the entire universe or the environment is enabling it to happen. For the active business to continue, a lot will depend on its ability or the talent's ability to continue to beat benchmark. And that's where the crux lies. The inflection point will come if this data changes substantially. But to answer your question, yes, the demography that we see in is definitely the younger lot. Moving very quickly to passive has been our last 1 year, very recent sort of experience.
Yeah, so let me probe this a little further. And as you rightly said, it is a trend, and we currently see that almost 5 to 10 lakh new folios are getting added in a monthly basis, even in passive funds, including the overall. And as I said, almost 40%. If you were to really try to take this discussion, and we are talking about this now 3 years hence from now, like going into the future, what is this change that you will see in terms of investors preferring passive, and do you see that a very sustainable change, or do you see, or what will drive that change, the inflection point that you spoke about?
See, Manoj, I'd like to clarify one thing. When again, I'll bring back the present market versus the incremental market perspective. The incremental market is where the explosion of folios will happen. Make no mistake on that. The penetration which was awaited by the industry is finally happening. And to be fair, a lot of it will happen on the digital format. And that is not saying that just the digital distribution. It is the present physical distribution in the form of the digital space. But invariably, the transaction space will be digitally driven. There is no doubt or debate on that. Right? From that perspective, when you look at the inflection point, I think the inflection point from a folio perspective is beginning to happen. And that's something which the data which you pointed out. I will stick my neck out and saying that, 25 years of folio creation from the active business could be replicated in the next 5 years in the passive business. And this is how it has happened globally. And these are two different investors. Make no mistake, this market might graduate a bit to that in that side, but there is a whole lot of new investors which will come in, and that's a separate sort of segment which will develop. Is the way we are seeing happening. The lot of the new folios which are coming, you'll be surprised to know the number of fresh KYCs have been pretty substantial. So that is an indication that there is a new market developing, and that's the demography of the country playing out, nothing else. So I'm sticking my neck out and saying that the next 5 years could see the number of folios created equal to the number of folios that we have in 25 years of active business.
That's amazing. That numbers are amazing that Swaroop you're talking. I'll take it to Chandresh also, and Chandresh, as we all know that globally it took almost 50 years for passive funds to unfold. It was in 1971 that the first index fund was launched. From 1971 to it took 1993 where ETFs started percolating. So from the launch of the first index fund globally, it took almost 20 years plus to for ETFs to start really going in. And here we are saying that it's just the beginning of passive explosion in India. And in the next 5 years, it could be a significant change in the way people look at active, passives, and a combination of that. So what are the key changes that, Chandresh, do you see in the next, say, 5 years, 3 to 5 years? And how will the investor behavior towards active and passives change, in your view, in India?
So I think my thinking is not so much about, again, as I said, active versus passive. I think investors today, because we are starting from a very small base, and as Swaroop pointed out, many of the fintech platforms which have been driving the folio creation for the industry, really getting a lot of new investors as well, they have been focused, especially after the Corona crisis, on the passives. Not that passives did not have a momentum, but in some sense it's got much further momentum in an environment where there has been a few sectors or the urge to diversify globally, etc. Those kinds of themes have been picked up. Now, many of these themes will continue to come, and so there will be an increase in the number of folios and the number of investors who will get into passives. But also the same thing, the same platforms, the same technologies, the same engagement models will also get people in actives. Until and unless the engagement model really changes and says, hey, the passive is really a much superior product, which to an extent, for some applications it might be, but for many is not. I don't think the actives are going to really give it up without a fight. And that's why I have my view of the future is it's going to be a lot more balanced. The important point being that, yes, the actives must deliver value. They are more expensive products, and in that sense, they must deliver value. And I would, in that sense, expect that long-term investors, after they realize if the actives are giving value, that you will see a migration of people from passives to actives, maybe. And it could happen the reverse way if the actives do not perform. Now, there's something very similar to what we see when there are a large number of demat accounts, and that's something which has happened over the last year. Right now, the markets are on a bull tear. There will be inevitable corrections. And as we have seen in the past, some of these investors will say, okay, I don't want to do direct equities myself. I would rather get the use or maybe use the services of an advisor, and in many cases move towards a mutual fund where I don't have to do it on a day-to-day basis and somebody can do it on my own. If not all my money, is certainly a part of the money. So the important thing is to get the people into the market, get them open to investing in equities, direct equities, passives, actives to the extent. And I think all these three markets will really, really grow. For that caveat, if there is a market which does not perform, obviously money will move away from that market to some other market. And I think the first thing to happen whenever it happens would be the equities market, because we all know there will be cycles. So that will be the first. And then actives and passive, whether one really, I think those will be more cyclical. Some parts of the market, people have been talking about large caps being disruptive by the passive. We'll have to see. Or maybe it's just that people who don't want to get into this whole discussion of deciding which fund to invest in, which is, to be honest, we as an industry have made it very difficult for people to really analyze, apart from just giving them quarterly or annual performance numbers. I think there's very little else which an investor has to really take a call. But anyway, if we are able to do that, we will be able to hold people to actives. Else, I think investors will figure out passives is the easy decision to make. Even though the numbers may be in favor of actives, I think the passives will continue to grow. So not a straight line answer. Passives, because of its base, will certainly grow. But I think I am seeing the entire ecosystem, 3 crore folios going to maybe 6, 7, 8 crore folios in the next 5, 7 years. All the 3 markets are going to really benefit.
Yeah, yeah. And one of the things that I'll take over to Navneet is one of the points that you raised is about the cost. There is too much focus in India on ETFs being extremely low cost products, at this point of time. And this is very divergent to the global view. In global, if you were to analyze, index funds are actually much cheaper. So we are just looking at data from BlackRock. BlackRock has index funds which charge in the range of around 5 to 10 basis points, but their ETFs actually charge around 25 to 30 basis points. So their ETFs are actually 2 to 3 times costlier than their index funds, and then that's true of most of the in the business. If you look at any family, whereas in India we see the discussion of ETFs most of the time is focused on cost. And the dharma of a passive equity fund has to be tracking the index or the tracking its benchmark very, very closely. So and we don't really see a lot of discussion point around that. So why is cost becoming a more higher imperative than tracking the benchmark? And do you see that discussion changing per se?
So, just echoing what Swaroop and Chandresh mentioned earlier, just 2 or 3 things before we talk about this. First of all, invariably, any discussion around passive goes in the direction of active versus passive. The significant increase in folios or the newer investors who are investing in passive are not necessarily voting against active. It's just that they are finding it easier. We should also see in the context of the interest in capital market in general from the millennials. And you can ask, any of the fintechs, Manoj, you know it better than most of us here, that the average age which has been coming down for the people who have been opening the newer demat accounts, and there, so maybe they are buying direct stock, they are trading in direct stocks as well as they are also participating in the ETFs. So I think we should see in that context, in last 15 or 16 months, 2.5 crore new demat accounts have got opened, which is substantially larger than the new unique accounts that our industry has generated. And maybe some of them are also investing into ETFs. And it's, just echoing what Chandresh mentioned just now, that I think both active and passive have a long way to go. We also talked about like 40 years or 50 years that it has taken for US to reach where it is. Our first index fund of HDFC was launched in 2003. And for the first 15, 16 years, I think the fund still remained very small compared to the overall size of the fund house or size of the industry. It's only recently that we have seen a lot more traction, and there have been a couple of products who've been around for long. On the cost side, in fact, I remember the day the largest ETF in India, where the EPFO put money. And coincidence that was the day when, if I remember correctly, that the Vanguard or BlackRock brought down the ETF fee to the 7 basis points. So I mentioned that, it has taken them 40 years to come down to this level, and we are starting from this level. And beyond a point, I don't think that like the cost should be the be all and all. I think we have to look at larger picture where all said and done, you use the word like explosive growth, but we are still like little over 2.5 crore unique investors. We have a long way to go. And I think have to look at the distribution dynamics and variety of other things in mind when we think about growth of passives as well in India. In fact, on across categories, we were doing some comparisons. In fact, you might have noticed that of late globally, there are already talks around that the fees on the passive side has completely bottomed, and there are marginal uptick in fees in some of the products already. And across the board, I mean, India is like probably one of the most transparent market in the world, but there are a lot of other hidden charges or even some of the income that the global ETF providers make. For example, on the SLBM side, on securities lending and borrowing mechanism, where in India that gets passed on to the investor, it doesn't get passed on to the investor globally. Chandresh earlier talked about the fund of fund and wrappers and all that, the kind of upfront fee which is charged to the investors. One should look at holistic picture. I think India is probably one of the most transparent market when it comes to the overall cost to the investor.
Yeah. So belaboring this, point of cost a little further, because of this growing discussion on cost, one of the perceptions that is growing is that the new age AMCs or the new age mutual funds, which are highly focused on, technology, they are highly focused on keeping their costs low, are better geared to manage the passive revolution or the passive change. So how do you really look at it from a perspective of new age versus the existing AMCs and the cost structure? Will that also lead to changes in the business model that the mutual fund industry is?
Yeah, asking me. So, I mean, globally, if you look at whether the top three AMCs which account for a little over 80%, and if one of the potential merger that is talked about, I think they'll end up with almost 85% market share on the passive side or on the ETF side. They have been around for a very, very long time. There are hundreds of other players who have entered the ETF industry or passive fund industry over the last few years or few decades, but still ETF is like a winner takes all market where the larger guy keeps becoming larger. In India also, you can see like some of the top players account for a very significant market share. But within that, there's a lot of scope for innovation. More the merrier. The market, I mean, is likely to grow tremendously over the next several years, as both Sarup and Chandresh mentioned earlier. From 2.5 crore unique accounts, will we not be 5, 6, 7, or maybe I would bet maybe 10 crore investors for the next couple of years? That will be there. And I think if the newer players bring in more technological innovation, product innovation, marketing innovation, I mean, if they provide better customer experience, that will be good for the consumer, good for the industry. They will keep everyone on toes. And it will be a healthy competition. I think ultimately the consumer would be a winner, investor would be a winner, and that's what we all look for.
Sure. I'll take the next question to Swaroop. Swaroop, so over the years, investors have put in some parameters of choosing funds, right? Active funds. A brand is one, the performance is one. And then there is standard deviation, and there are so many risk factors and there are people use different parameters, as simple as looking at the last 1 year performance to putting a factor of various parameters together while choosing various, funds. Now, when passive comes into play, the decision-making factors are completely different. Okay, whereas we currently also see that investors are still grappling to understand how do you choose a passive fund. How do you see, if you were to guide investors, how do you really evaluate a passive fund? On which parameters are key in selecting a passive fund? What would your, advice to investors be on that?
So I think the passive business is far more tougher than the active business because, the active business, you can definitely differentiate by performance and, like you said, invariably, whatever we say, the near-term performance finally, decides the allocation of funds. That's how the industry has played out, and we sometimes wonder what we need to do to change that. But when you look at the passive side of the business, there are two types of businesses, and India is very lucky to have witnessed the entire, the way the US market has played out. From basic market cap indices or the basic market cap passive funds which are available, which are broadly Me Too funds. And that's where the game is very tough, because that's where I do believe the larger players or the funds with brands, if I can say so, will play a major role in that side of the market. Unless, the younger players or the new players come in and give a far more efficient structure in the form of their tracking errors or providing fantastic liquidity to investors. And that's where the younger players can make a difference. Otherwise, I personally believe that the market cap indices, or whether it's in the index form or the ETF form, will be a play of the large players. But where the new age players come in is ideation of products, and that's where the story is pretty diverse. Because when you look at the active business, after the categorization of funds, the products are more or less laid down. There is that many products that you can get, and within that there is a really Excel file of performance which the competition is on. But if you want to look at really exciting products and ideation going forward, and we Indians have been very fortunate to see the smart beta part of the US market unfolding, for us to not having waited so long or to learn it ourselves, is where the excitement is. We feel that the Indian brain is superior to anybody in the world. And I do suspect that some of the ideation from the group of AMCs that we have, whether new, old, or whoever, that will come out will be incredible for the investors. And that is where it is a level playing field, according to me. And some of the products that can come out because of this beauty of the passive business, of where there is an underlying investable potential, there can be an index and there can be an ETF or an index fund, whatever. So the opportunities of the permutation combination are large. Yes, that is where the investor needs to I would definitely look at a guide, because the number of products, like Navneet pointed out, 1,327 products till date this year, that is 7 ETFs per day, is that business. It is not the active business, which is buy and hold for an AMC. You launch a fund and create a 20-year track record, and that is where this business changes. It is a product a day. People have to get used to new products coming in, and it's not for criticism. That's how this business is, and that is how this business will play out. And this is where I feel the new age funds can come in, ideate very differently. And mark my words, for a good product, there will be cost. For the basic market cap indices, there may be a low cost product, but any fund which comes with a superior idea will command a cost in the market, and that is where the business will be differentiated.
Sure. So I'll come to the last aspect of our discussion today. Is how do you build in advisory into ETFs, or passives, or is there a need of advisory? Because one of the ways one can always counter argue is that passives are simple products and you don't need advisory, and that is the way, and hence it's a direct to customer kind of a product. Or the other is that passives also need advice in terms of constructing the portfolio of what kind of passives. So how do you see that integration of advisories to distribution coming into ETFs and passives? And I can leave this question to anybody of all three of you who can would want to take it.
And one can take drugs to treat anything versus, somebody who goes to a doctor or a physician for a holistic checkup and take the medication. It's up to each individual. And I don't think there's like a specific advice for passive versus specific advice on active. I think it's better an advisor who understands the entire background of the investor in terms of their goals, their time horizon, their liquidity preference. I think their overall, I would say, emotional, who understand holistically an investor would be better placed to create a portfolio for the investor in the right manner.
So
Well,
if I could...
Sorry. Yeah, sorry, Chandresh, go ahead.
So my sense is that, I think good quality advice, and this is despite all the good efforts made by all our intermediary partners, distributors, RIAs, etc., is still fairly limited. In the sense, a lot of people don't have access to it. So forget about passives. I think even on actives, I think there's lots to be done in terms of hand-holding the customer, allowing him to really take the benefit of mutual funds and equity markets in that sense. And so it's important to have a very clear and simple engagement model. And I think with the fintechs and technology, I think it's getting easier. I think the first round of robo-advisors who came in globally, I think while the transaction platform and dispersion of advice was there, but the engagement model in terms of handholding was still not there. I think things will get better, are getting better. And I think many of the fintechs have started doing a good job of that, and that will get scaled up. So I think what will be the game changer, in my view, from this industry going from 3 crore investors to 10 crore investors is going to be this. Today, how do my products really help you? So rather than saying that I am going to have 500 new ETFs, I think I try and understand you, engage with you and say, maybe this portfolio of 5 or 7 products takes care of 95% of your requirements, and then there could be the additional stuff which happens. Now, this could happen on technology platforms, either owned by the AMCs or owned by intermediaries, whatever. But actually, the engagement model needs to change from saying, hey, I have this great product, to, hey, you as an investor, what do you want? And Navneet just mentioned understanding risk profiles and all that and goals, etc. It has to be done meaningfully well using technology. Because using the traditional models, many of the advisors and intermediaries are doing a great job, but there is a scale issue there. And that's where with technology and platforms, the scale can really be really expanded. So it will work for both. It will work for actives. It will work for passives. And I think that is until unless we get and engage from a 20, 30-year perspective with these investors, I think people will come, they will dabble, and then somebody will just go at the first sign of trouble. And we've seen that in the past. I'm not saying that it will happen again, but we should be alive to the fact that if we have a 30% drop in the market, how many investors, these new investors, will stay? I mean, and sometimes what happens is when you get investors coming at the top of markets, then they don't come back. Many of them say that, hey, this market's not for me, and they may probably never come back or come back after 10 years. So I think better to engage with them on a long-term basis and then try and fit where the passives fit in, where the active fit in, and make it very easy for the investor, rather than just telling him that, hey, I've got 500 different ETFs available and 800 different actives available, and say, hey, and hence you decide which one is good and bad. I think it will just be too much to ask from investors. So get an engagement model right. So you ask the question, how do you compare at passives? It's the differentiation might happen at the innovation-led different passives. So somebody does a really great new product idea, but I think the differentiation will happen at the engagement level. How we are able to personalize, customize messaging to investors. It's happening in every industry. We need to learn to do it, and we really hope the fintechs can really show us. We want to learn from others, from fintechs, to really take the engagement level of the industry as a whole with the final customer to a really different level.
I think, Manoj, we are at a very interesting situation, because when you are wrapped up at home for 2 years and facing a near-death situation, a lot has changed in everybody's mind. Finally, we've been able to differentiate between what is our need and what is our want. And we have been catering only to our needs, and life has been okay. So here is the opportunity. And that's why I do believe that post-COVID will be the birth of financial advising. Post-COVID will be a complete conversion to a full portfolio process, and that is the opportunity. The opportunity of forming a core and satellite portfolio, whether your core is active and your satellite is passive, or the other way around, is what is an opportunity both to the present existing distribution model, to the rising RIA model. Of course, now the rampant, I use the word rampant because the folios are being created pretty incredibly by the fintech model, and also for the AMC. Finally, as Chandresh rightfully mentioned, it is about solutions going forward. But the business is about providing solutions. Who provides it will take the opportunity. The opportunity is there for all of us. And I just hope and pray that this opportunity is not pushed back to the asset management companies. It is a business of advice. Please understand, when it is pushed back to the asset management companies, we are biased sellers by virtue of the job we do. And hence, we will push our own products. And that's not right in the selfish interest of the investor. The opportunity is incredible. And I just hope and pray that through the use of tech, both the existing investors, the existing distributors, the forthcoming or the future distributors, just take it to a level where, and then make no mistake, there is a shift from fixed assets to financial assets. We saw in Mumbai the incentivization of real estate down to 2% on the stamp duty fees, and there are that many houses that got sold. Right. So that era is coming to an end, and there is a definite shift to financial assets. So the opportunity is humongous. It will be very interesting to see as to how it plays out and who takes up this opportunity.
So, Swaroop, on that need versus want, I remember Steve Jobs quoted Henry Ford very nicely that in the early 20th century, Henry Ford said that if I had asked customers what do they want, they would have said a faster horse. They would not have said a car, but what they really needed was actually a car. So in our industry as well, it's not about too much of product innovation or just bringing it down by one basis point and providing the cheapest ETF. It's a holistic solution to the investors so that they can meet their goals. I think that's where that engagement, that understanding them fully and providing what they really need is the need of the hour, honestly.
I completely concur with what Navneet just said. The needs and wants currently are and what investors want are completely different. This has just been such an amazing discussion with all three of you. I really thank each of you for giving these insights, and I'm quite sure people watching this will have taken so many takeaways from this in terms of not only passives but the overall mutual fund industry also, and how to look at actives and passives together as a combination rather than looking at as some two different aspects of the business. I cannot let fund managers who are on the show going away without a prediction. So I will ask you a prediction, but not about the Sensex or the Nifty because the markets are on roll. But one of the key things that came across the entire discussion was that the next 5 years is going to see significant growth and a complete change. So what I would request each of you to predict is in the next 5 years, what do you see the entire size of the industry for the mutual funds? And Navneet did say that he sees the number of investors growing from 2.5 to 10 crores. But translating into assets of the size of the industry, I would like you to take a shot at this.
So at our end, our mission is to be the wealth creator for every Indian. And for us, it's like how many investors we can reach out to. That's, I think, a lot more important. And we are working with a missionary zeal on that. So I wouldn't really hazard a guess on the number or the amount of AUM that industry would be managing. I'm sure, you can extrapolate where we are and look at India's growth over the next 5-7 years. By the way, Chandresh and Swaroop also have been around for long. At any point in time, whatever prediction that we had right from early 90s, I think industry has proven us wrong. It has always been a number higher than whatever we could think of.
So if I have to take a shot, last 10 years, I think we've grown at some 17-18% compounded. I think with technology coming in, with better engagement models, with move from real assets to financial assets, I think why we should not have a number higher than that. I'm not hazarding a further number onto that. But I think the one thing which I would certainly like to highlight, there will be a trend towards more ownership and focus on underlying portfolios. And I think that the great opportunity is there as well. At the end of the day, mutual funds are conduits to building a portfolio. Yeah, I just hope we are not, in some sense, disrupted by some of those technologies. We certainly, as an industry, for people who are looking to passively manage their portfolios, money will stay here. many of the people who are going to actively wanting to manage, maybe some of that money can move out as well. So we have to be just focused on that as well. But still, I would think there will be a lot of people who will come from direct equity into mutuals. There will be some people who will want to move from mutuals into direct equities, building models. There's a lot of money which has to move globally. I think today there is a lot of restriction, and in fact, anyway, just newer, just beginning. Overall, in Indian investors, money could be anywhere 10 to 30 or 40% in global markets. I think the ideal way to move that money is through mutual funds. So that's another growth area for us. So yeah, I mean, a 20% growth means you compound every 4 years. So if you're saying 10 years, then we should have at least 2 compounding cycles. So we should be 150 lakh crores or whatever that number comes out to be. Doesn't make sense. Doesn't matter if it is 150 lakh crores or 120 lakh crores, but it's probably even more than that. So yeah, it's really, really big numbers. I think all of us can be happy that we are part of a good growing industry. We will all benefit.
I think Chandresh has already proven my number wrong. I was predicting 1 lakh crores in 2030, and he's putting 1.5 lakh crores, which I also agree with. But I'll stick to 1 lakh crore 2030 with a twist that 25% of the assets will be passive.
100 lakh crore.
100 lakh crores. 100 lakh crores, yes. We have 30 lakh crores, 100 lakh crores in 2030. Industry is 9% passive, will be 25% passive.
Amazing. These are and as Navneet rightly said that whatever numbers in the past that have been predicted have usually the industry has done much better, and I hope so this is again true in the next 5 years also. Thank you once again everybody for giving these insights to everybody. We really appreciate your time and effort of being here and giving those insights. Thank you.
Thank you very much. Really lovely to be here and providing me the opportunity. Thanks.
Thank you.
Thank you so much, Navneet, Swaroop, and Chandresh for this amazingly insightful conversation on passive investing. I'm sure all the viewers looking at this have taken away something that will help them in taking good investment decisions in passive investing. I would also like to thank all the viewers for staying on and listening to this conversation. And I would request everybody to continue looking at this for more such insightful conversations coming forward for you.